We think in the small cap cycle, we're approaching the end of a fairly decent period of underperformance. Over the last 5 years, small caps have underperformed the ASX 200 by roughly 25 to 30%. However, the bulk of that underperformance has happened since the start of 2022. That has coincided with the end of interest rates just going down and down and down, and obviously had a huge blowout at the end of 2021 as we sort of hit the end of COVID stimulus. We hit 2022 and what happens? Inflation turns up, interest rates do a massive U-turn, and lo and behold, small caps, which are more exposed generally, but not definitely, to economic activity, have started underperforming, hence that underperformance over 5 years. But the bulk of it has been shorter and sharper and has happened in the last 18 months. The minute we think we hit the end of that interest rate rising cycle, which feels like it's sooner rather than further away, we think at that point small caps starts to recover its underperformance. Well, here's the thing. We are actually expecting an earnings recession, i.e. we think if anything going forward from here, whether it's small caps or perhaps some of the mids or some of the big caps as well, are more likely to struggle to maintain earnings and may well have earnings go backwards. But just because we get an earnings recession, if we start getting interest rates being cut, what might actually happen is the actual stock prices might actually bottom, because you'll have a period where the earnings flush out, cost bases get reset, but the market will anticipate that the recession will last 1 quarter, 2 quarters, and then things will start to recover. It feels like this telegraphed recession has been like the most telegraphed thing of all time, but it definitely feels to us that the pressure on earnings just continues to slowly but surely build. Trying to put a timeline on it is difficult, but we think it's coming. Whether it's the bottom is the August reporting season, probably feels a bit soon. If I was to take a stab at it right now, I would say February, somewhere in the middle of it. Well, at Eiger, we have a qualitative and a quantitative part of our investment process. If we look at the qualitative part, we set that out in our 9 commandments. It's a set of rules, a set of hokey rules that we've used for more than a decade now. They're just things we run through when we're looking at businesses after we've done some numbers as well. There's a couple that maybe spring to mind. They're all relevant all the time, but a couple at the moment that do spring to mind are being fairly focused. If we are going to run into a period where earnings come under a bit of pressure, maybe the outlook statements are not as good, is perhaps one to focus on at the moment is have a look what insiders are doing. And these are the sort of C-suite management, perhaps directors. Just have a look at whether they tend to be buying shares in the businesses that they are associated with or selling. Now, in a funny sort of way, every time an insider comes out, hopefully in an appropriate trading period, and not all companies follow that, by the way, when they come out and sell some stock, we've been in this game a long time. We have never ever seen a managing director or a C-suite come out and say, I'm selling some shares because you know what, I think we've had a really good couple of years, earnings have probably peaked, it's about to get tough, so I think I should sell a few, whether I've bought them or got them through some sort of incentive units. That has never ever happened in our careers. What does happen is my financial advisor told me to, I've got divorced, I need to buy a house, I've got a tax bill. That's what they always say. Not in living memory has anyone ever said, I'm selling these because they're going down. They always come up with that. Incidentally, if they buy stock, there's only ever one reason why an insider will buy shares in their own company, and that's because they think earnings are going up and the share price will follow it. So when we get this litany of stuff as to why my financial advisor mysteriously today told me I need to diversify my ownership or my wealth or whatever, just be wary. That's probably, possibly, maybe true. It's also highly likely that the insiders are looking out at the next 18 months going, you know what, this is getting tougher. And the other one that, in our suite of commandments people often find amusing is we are just very, very wary of companies that overindulge in paying consultants, where they've hired former investment bankers as their senior executives, and as a rule, it takes a lot to convince us to buy stock off private equity when it is either IPO'd or when they're doing consequent sell downs. So there's just a couple of things that we follow. One that we think is probably in a slot, and funnily enough, having just talked about private equity, they are also often the purchasers of businesses, and we've seen Nitro Software, for example, was one that recently got taken out by private equity. A company we think looks ripe for this sort of activity would be Integral Diagnostics. It is one of Australia's largest groups of imaging, MRIs, CAT scans, PET scanners, X-rays, that sort of thing. They've got a large network around the country. It's been a very, very poor performer over the last couple of years. COVID has made it, elective surgeries have been deferred. Surgeries are constantly being, scheduled and then cancelled, and consequently that volume of elective and essential surgeries has hammered their, volumes through their radiology practices. But radiology is a very stable business. It's recently got some price rises in the latest budget that the government have put through. It would appear to be off its knees. Volumes are returning, but the share price is way, way, way down from where it was a couple of years ago. But if we're going to run into tough economic times, there's a business that is as immune as it gets. It's really struggled. The share price is up a little bit from the bottom, but not a lot. It's very defensive, and it's the sort of business someone could buy, and probably out of the restrictions of public markets, it can carry a lot of debt, which is normally something that private vendors like. They can gear these things up, and that's a good way of extracting capital. So that's probably an M&A target we think is sort of out there.